that, there is no doubt that the coronavirus and the spread of the coronavirus is affecting the markets and thus affecting your 401k likely. You guys have heard me say a lot of times when we talk about 401k and investing, and we talk about burying the shoebox or hiding it in your mattress, unless you hid it in your mattress or buried it in a shoebox last week, you probably saw the value of your account go down. The S&P 500, just over the last 7 days, not counting today, the S&P 500 was down 13.5% in the 7 days leading up to this morning. I know my personal 401k is down about 14% from where it was just 2 weeks ago. And I know those aren't easy statements to open, and they're not easy websites to click on. And it's not any fun. And we acknowledge that it's not any fun. But let's talk a little bit about sort of where we go from here when the market does things like this. And I'll ask for you, I'm going to be switching around a couple of different screens here in a minute because I want to show you a few things that I thought were interesting. But those are the numbers where we are today. Now, this is what I'm not doing today. I know you guys knew this already, but obviously I'm not at all involved with investigating or figuring out a solution to the coronavirus. We don't have any idea where it's going to go. Certainly, you read and it's scary and it sounds like it's going to continue to spread. I don't have any idea where it's going to go, and I don't really know how the markets are going to react to it, either in the short term or the long term. I don't know where this is headed. My guess is that it's at least going to be very volatile, but short of that, I wouldn't want to make any kind of guesses. And even that, who knows? Who knows where we're really going to go from here? Certainly, though, the virus is affecting things. It's affecting both internationally and here in the United States. And so we'll just kind of see where it goes. I think these are some of the things that I'm trying to remember with my account, and I would encourage you to think about with your account. And this is where I'm going to be switching back and forth to a couple of different attachments. But the first thing I would say is this has happened before, and it will happen again. Not the coronavirus specifically, obviously, but markets decline. Sometimes they decline quickly and sharply. We have seen this happen a number of times. Let me point out this here, and this is from a tweet I saw just yesterday from downtown Josh Brown. So I want to give credit where credit is due. But this is just since March of 2009. How many times we have seen kind of spikes in the market declines and the reasons to sell. He was being facetious with this. How many times since March of 2009 we have seen it really, really decline? And you look right here, Dow falls 1,000 points for the first time in a day. Does that sound familiar? It sounds a lot like last week, right? Global sell-off in China. Moving over a little bit, you see where the S&P 500. You'll see the trade disputes just last December. Everybody remember this one? And I know we've talked about it in a lot of our meetings last December when the S&P was down over 10% in December alone, and everybody thought, oh boy, here comes the next recession. The point of that chart being that just in the last 10 years, we have seen a number of times when the market has declined and declined quickly. And over the last 10 years, it has bounced up. Now, does that mean it's going to happen next time? No, it doesn't mean it's going to happen next time. We'll see where it goes from here. But we have seen this happen before, and it will happen again. And we just ask that everybody continue to stay patient, have discipline. We are going to see this again, and we've always recovered from it in the past. Now, let me see how I can erase that. Erase all drawings. There you go. So this has happened before and will happen again. Buy low and sell high. Everybody wants to do that, right? That's the oldest saying in investments. We want to buy low and we want to sell high, not the opposite. Well, guess what you're doing if you make adjustments to your portfolio after it went down 13.5% over the last 7 days? You are buying high and you are selling low. That's the exact opposite of what we're trying to do. We want to stay away from trying to time the market. Timing the market, trying to time the market has proven to be a loser's game for a long, 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 long time, and it will continue to be a loser's game for a long, long time. Do not try to time the market. We don't know where the bottoms are. We don't know where the tops are. We stay in it for the long term and let it work for us. I'm going to pull up another chart for us. This is the market's response to crisis. This is a portfolio of 60% stocks and 40% bonds. So yours may be different than this, but it generally tells the same story. What's happened to the market after crashes? 1987, the stock market crash. For the year after that, it was up 19.5%. 5 years later, you'd have been up 76%. Obviously, 2001, September 11, 2001. We were talking about the office this morning, not to equate necessarily what's happened to 9/11, but in the aftermath of 9/11, the market was down almost 25%, I think, the following week, and where it went after. Look at all these, the similar story. When we've gone through these crises, it has ended up the following year, 3 years, 5 years, moving up, and a lot of times it moves up very, very quickly. Here's another one I wanted to share with you. That's the same one. Let me get back to this. Sorry, guys. Here's another one. In terms of trying to time the market. Now, these are using different indices, different types of index. This was the Russell 3000, I believe. But look, this is showing what the difference in your overall return would be if you just missed out on the best days of the market. If you missed out 6%, if you missed out on just the top 10 days, your overall return goes down over 3.5%. If you missed out on the best 50 days, and this is over, again, going back to 1999, right? So this is over a 20-year period. If you missed the 50 best days over that 20-year period, your overall return is down over 11% from where if you just stayed in. So not timing the market has proved over and over and over again to be a loser's game, to just stay in it and let it come back for you. In fact, the stat, it's not on this sheet, but I've got a note earlier today talking about missing the best days in the market. Of the 25 best days of the last 20 years, 24 of them happened within a month of market lows of these kind of declines. So a lot of times the best days happen real quickly. And in fact, and I'm not going to tell you that this is going to hold, but as it stands right now, the market is up almost 3% today. Now, where is it going to go between now and close? I have no idea where it's going to go between now and close. Perhaps it's getting ready to take a sharp decline. But if you had reacted last week and said, take my money out, guess what you would have missed today? You would have missed almost a 3% run up already today. So we don't, is that a guarantee of what's going to happen next? No, we don't have any idea what's going to happen next. But history shows us that timing the market is a loser's game. Again, here it is in terms of just strict dollar amount. This is going back to the S&P 500. This takes to a period, again, this goes back even further. This goes back almost 30 years. You can see the total period, the compound return is 9.29. If you just missed one best day, the number one best market return day over the last 28 years or whatever that adds up to be, you'll see you miss 0.5%. And in real dollars, that's investing $1,000 in October of 1990. It would have grown to $13,137 through 2018. You cost yourself almost $1,500 just by missing the number one best day. And look, if you missed the 25 best days, if you're somebody who's really trying to time this thing and you just weren't there on the 25 best days of the market, it's almost a $10,000 difference on $1,000 invested over that 28-year period. Huge, huge difference, which again goes back to timing the market is something we want to stay away from. So a lot of these are going to sound very similar to things we just went over, but we want to avoid making emotional decisions. Now, how do we avoid making emotional decisions? I tell you what I do. I turn off the TV and don't check Twitter, which was of course on the memo that we released last week. Try to avoid making these decisions. Stay disciplined. Stay true to your long-term strategy. Don't let these short-term blips cause you pain and suffering, and which leads right into the next. And don't let short-term results affect long-term strategies. Stick to your plan, right? Don't let the media scare you. We've just talked about that. This one right here I wanted to point out because I got this question a couple of times last week, and I think we're all on the same page with this. But just to make sure, I had a couple of people said, "Well, I lost X amount of dollars last week. My account, I lost $2,000, lost $4,000, whatever the case may be." and I'm not trying to be a smart aleck by saying this, or just trying to play total semantics, but I do think it's important to say, did you lose money, or did what you own simply lose value last week? Because you really only lose money if you decide to sell on a day when the market is really down, right? So if you own a share of a fund and the share was at $10 and all of a sudden the share is worth $8, you still own the share. And if the share goes back up to $10, you made that money back. So I don't think you lose money until you decide to actually sell whatever it is that you own, which of course leads into the last point was, and I hear this one around my office a lot. I've shared to you all the story of me and during the height of the recession in 2008, when my account was down over 60% from where it had been 2 years earlier. And as I was hemming and hawing, my boss asked the question, so that's too bad. So were you going to spend that money tomorrow? You know, if you weren't planning on spending your money this week, what does it really matter what what happened in the market last week? And if you were going to start spending your money this week, as we've talked about many, many times, we should have been taking significant amounts of risk off the table at least 2-3 years ago, if not more than that. So I think for the vast majority of people, maybe all of us, really what the account value was last week doesn't really matter. It's not fun to open it. We don't like to see it, but where the account was last week ultimately doesn't matter. It really only matters what your account is on the day you get ready to start spending it. So all of these add up to, yes, it is not fun. Nobody likes to see it, and we don't know when this is going to turn around, but history tells us that it is going to turn around. And history tells us that oftentimes it turns around very, very quickly. And we want to continue to have our strategies in place so that when those good days happen, we are there to take advantage of them. All right, I'm moving through. Sorry, y'all, there it is. Whoop. So these are all things that you guys have heard me say many times, right? But I just want these four sayings to kind of stick out in your head. Remember these as bad news comes around, because the only thing I can guarantee you is that this will not be the last time that the market goes through these types of fluctuations. This will not be the last time that we see declines, right? Economies go up and down, markets go up and down. There will be days, weeks, quarters, years where the value of our accounts are going to go down. But so far, anyway, as India.Arie said in her song, "This Too Shall Pass," and full disclosure, I don't know who India.Arie is. A lot of people have kind of done a version of "This Too Shall Pass," but this too shall pass. We'll figure out the coronavirus. The economies will recover. We'll get back on our feet, and we'll continue to move forward. You guys know me and have heard me talk about the Shawshank Redemption, how much I love the Shawshank Redemption. When Morgan Freeman said it's about pressure and time, right? And that's 401k, that's investing as well. Time being the key. Give it time to work for you. Don't make emotional decisions. Don't make short-term decisions. Let it work for you. And this third one, maybe now more so than ever, rate of savings is more important than rate of return. We've talked about that a lot in our meetings. The way your account, the secret to saving for retirement is to save for retirement. It's not any fun to watch rates of returns go up and down, but your dollars are the key to how your account is going to grow. And don't forget, again, not to be insensitive to what's going on around the world right now, but to the extent that you're contributing to your 401k right now when the market is down, you're buying things at a lower value. Remember, buy low, sell high? Well, that's what's happening too when you're buying during these dips. The rate of savings is more important than the rate of return. Oops, that's a typo. Sorry, than the rate of return. So that's why in our memo last week, I said that one of the things to do when markets go down is to consider increasing your contributions, right? If you have the flexibility to increase your contributions, think about doing that. See if you can buy more when it's at a lower value, so then when it goes up, you stand to reap the rewards of that. And finally, I end every meeting by saying the same thing, which is to say, you know, something we've never heard anybody ever say is, "I wish I hadn't saved so much money," right? So far, nobody has ever said, "I wish I hadn't saved so much money." But we have heard a lot of the opposite. So please don't make rational decisions. Please, oops, let me get out of this. What am I doing there? Sorry, guys. There it is. So we don't know what's going to happen, but we know what history has told us. We know we're not going to make emotional decisions. We know we're not going to worry about what happens during a day, a week, even a quarter. We're only concerned about what happens in the long term, what our long-term strategy is, and focusing on what the account balance is going to be on the day we have to start spending it.